As interest rates rise, it can put downward pressure on stock prices. The theory goes, an increase in inflation can push up bond yields. As a result, investors can collect higher interest from risk-free government bonds. So why take extra risk investing in the stock market? On top of that, higher inflation can increase costs for companies. Now, for short-term investors that will need to cash out in the near future, bonds can be a decent way to go. And more specifically, tips if you're interested in protecting against inflation. But for long-term investors like me, stocks are still a much better choice. That's if I'm looking for higher returns, or if you're looking for higher returns, like I hope most of us are. And even better, certain businesses are able to increase their product and service prices right along with inflation. That's why I'm sharing my top 6 inflation stocks today. And these aren't any ordinary stocks. They all pay dividends and have a long history of increasing their payouts. So as inflation climbs, the dividend growth alone could easily outpace it. And before I share these great stocks, just one last quick note. There are lots of great companies out there, but not always relative to their price. In the words of Warren Buffett, whether socks or stocks, I like buying quality merchandise when it is marked down. I also try to buy quality goods and businesses when they're on sale. Now, it is tough with the market near all-time highs, but for now, these 6 inflation stocks are towards the top of my buy list. Over the coming weeks and months, I might buy into a few of them, so feel free to subscribe for updates. All right, coming in at number 6 is Flowers Foods, ticker symbol FLO. This company produces and sells bakery foods across the United States. Some of its mini brands include Nature's Own, Dave's Killer Bread, really good stuff, Wonder, and Tasty Cake. The company is improving its supply chain to help offset inflation and also has the ability to pass along some of the costs or the increases along to customers. All right, so some quick highlights. The dividend yield comes in at 3.39%. The payout ratio is above 100%. Now, that's not great, but it's coming down after a tough year. And when looking at free cash flow instead of income, the payout ratio is more reasonable. So the dividend looks pretty safe going forward. The PE ratio comes in at 33. That's also a bit on the high end, not great. And it's higher than the past few years. But this makes sense with the recent earnings pressure, which should correct a bit going forward. Now, a metric I prefer more on the valuation side, EV to EBITDA, comes in at 15. It's enterprise value to earnings before interest, tax, depreciation, and amortization. Accountants have less ability to manipulate this number, and generally for value investments, the lower the better. Coming in at number 5 is Procter Gamble, ticker symbol PG. So Procter Gamble is a household name, or at least many of its brands are. Just to name a few, Tide, Downy, Pampers, Bounty, Gillette, Crest, Mr. Clean, Old Spice, Head & Shoulders, Herbal Essence, and Febreze. So the company has a huge portfolio of consumer goods and also has the ability to pass along some of the rising costs to customers. The company is also an elite dividend king. This means it's one of the few companies that has increased its dividend for the last 50 consecutive years. The dividend yield comes in at 2.47%. That's on the lower end of this inflation stocks list, but it's still good given the lower interest rate world as well as the payout safety. Or the payout ratio comes in right at 59%, so there's plenty of wiggle room. From the valuation side, price to earnings ratio of 24. And then EV to EBITDA, a much more respectable 16. So not bad given the overall stock market valuation. Now, coming in at number 4 is AbbVie, ticker symbol ABBV. AbbVie is a huge biotech company, and the majority of its revenue comes from just one drug, Humira. Although the company is diversifying and has a strong pipeline in the works. It also has a long track record of paying dividends. It's paid them for almost 100 years, since 1924, and has consecutively raised them over the last 48 years. Healthcare costs continue to climb, and investing in AbbVie can help you kind of hedge those increases. The dividend yield comes in a nice 5.03%. The payout ratio is well over 100%, but should come down as the world starts returning to normal. From the valuation side, PE ratio of 38. That's not great, but once again, relative to the rest of the market, not too bad. And then the EV to EBITDA comes in at 21, so a little more respectable. Now, the third company or the third inflation stock to consider is 3M, ticker symbol MMM. And just a fun fact, 3M used to stand for Minnesota Mining and Manufacturing. Since the company has continued its conglomeration domination, the company has over 60,000 products and generates nearly 50% of its revenue from outside the Americas. This diversification has helped 3M pay shareholders a growing pile of dividends over the years. Right now, the dividend yield comes in at 3.14%. The payout ratio is also pretty solid at 64%, so plenty of wiggle room. PE ratio, looking better than some of the others on this list. It comes in at 20. And EV to EBITDA is a very respectable 14. Now on to number 2, Realty Income, ticker symbol O. Realty Income has a portfolio of over 6,500 properties, and its occupancy rate comes in close to 98%. It's diversified with properties all across the US, along with a few in Puerto Rico and some more in the United Kingdom. It is really important to distinguish that Realty Income is a REIT, or Real Estate Investment Trust. It has a favorable tax situation, but in return, it must generally distribute at least 90% of its taxable income each year. So that can be great for income investors. Also, over time, it can pass along inflation increases to its clients. Right now, the dividend yield comes in at 4.57%, not bad, and it's also one of the few companies that pay monthly dividends. The payout ratio is over 200%, and when looking back over the past 10 years, it's always been above 200%. Now, this might seem unsustainable, but that's because the standard payout ratio is not very useful. It includes earnings, and accountants can manipulate earnings in many different ways. It really doesn't give us much insight into cash flows of a business. So this really isn't too concerning for me, and dividend payouts should continue. On the valuation side, a price to earnings ratio of 54. That's the highest on the list, but it's not as unreasonable for REITs. And an EV to EBITDA of a better 23. If you've subscribed to my channel and have seen my recent videos, this next dividend inflation stock shouldn't come as a surprise. Right now, top of my list is Verizon, ticker symbol VZ. Verizon is another household name, and it's a solid inflation protection stock, as well as a defensive play. It generates most of its revenue from telecom services, and many of the phone and data plans are last to go during tough times. The company's steady cash flows have allowed it to reward shareholders handsomely. The dividend yield right now comes in at 4.46%. Payout ratio very reasonable at 58%. A price to earnings ratio of just 13, and an EV to EBITDA of just 8. Verizon is easily on the top of my list. Of course, it's not risk-free, same with other stocks on this list. Although Warren Buffett has given it a strong vote of confidence investing in Verizon. To learn how you can buy at a better price than Warren Buffett, you can check out my recent video here. I'll also link to the video down in the description below. If you'd like to see more investing opportunities like these inflation-proof dividend stocks, please let me know in the comments, or let me know if you have any other questions. While you're down there, I'd really appreciate it as well if you just tap that like button, as well as subscribe. Thank you, and more to come.